Leggett & Platt's stock price is down around 45% since its recent peak in May of 2021, almost 2 years ago, and their earnings in the last few quarters have been lackluster to say the least, and management doesn't exactly expect those conditions to improve very much, if at all, in 2023. So the question we'll try to answer in today's video is whether Leggett & Platt's dividend is safe and whether they'll be able to continue increasing their dividend each year and maintain their dividend aristocrat status. Leggett & Platt is a diversified manufacturer that specializes in bedding components, automotive seat supports, specialized bedding foams, components for home and work furniture, and flooring underlayment. So a lot of their products are in rather cyclical industries, so it does make some sense that the company has been struggling a bit recently. But let's take a look at their full year 2022 financial results to see exactly how they did last year. For the full year of 2022, sales were $5.15 billion, which was actually an increase of 1% compared to 2021. But Leggett & Platt tells us that volume was down in that time period about 7%, and the slight increase was caused by about a 9% increase in the average price of goods sold, and that was mostly related to an increase in raw material prices that Leggett & Platt was just passing on to their customers. And earnings per share for the full year was $2.27 per share, which was a 22% decline from the 2021 earnings per share of $2.94. Some notable things to see from the results as well is that they were cutting back on production of some various products in the latter half of 2022 because inventory was starting to pile up as demand weakened, and so the cutback in production helped reduce their inventory and bring it back to better levels. And as of now, they are expecting about the same production levels in 2023 as they experienced in 2022, even though these levels are below what they would typically see in most years. Additionally, their specialty foam mattress segment struggled a lot in 2022 because of higher chemical costs and sharp drop-offs in demand towards the end of the year. From reading management's comments, these issues aren't really expected to improve all that much in 2023, but I personally think they will start to improve within the next few years, and probably by 2024 we'll see some material improvement, but there's really no guarantee of that. That's just my educated guess at this point. So the company is definitely performing poorly, relatively speaking, to the previous few years, but let's take a look at their dividends in particular and see how safe or sustainable it may or may not be. In 2022, Leggett & Platt had net income of $310 million, and they paid dividends of $229 million, which gives them a payout ratio of about 74%. And this is a bit on the higher side of what I like to see, but given that Leggett & Platt is a bit of a higher yielder with less dividend growth, I'm okay with that, on the higher side for the payout ratio. But last year's payout ratio is less important at this point than this upcoming year of 2023. So let's take a look at those numbers as well. In 2023, management is expecting dividend payments to total $240 million. This means that they likely won't raise the dividend at all in 2023, but that won't cause them to lose the dividend aristocrat status, because that would still be more dividends paid in 2023 than in 2022. So although they don't provide an actual number for total net income guidance that is expected, they do provide earnings per share guidance of $1.50 to $1.90 per share, and they say that shares outstanding is expected to be 137 million on average, which would give them net income in the range of $206 to $260 million for the full year of 2023. So this is obviously not a good sign, because earnings would have to be on the higher end of that net income range to fully cover the $240 million of dividends in 2023. And that's assuming that all their assumptions are correct and kind of play out how they're foreseeing it, which is certainly not necessarily going to happen. So if Leggett & Platt can't pay the dividends from their net income stream, they will have to use some cash from their balance sheet, or they'll have to raise some cash through either share offerings or debt. I think most likely they wouldn't want to, issue debt or shares in order to pay the dividend. So if they had to take it out of their cash, we can look at their balance sheet to see how that would affect the balance sheet. We can see here on the balance sheet that cash and cash equivalents was $316 million as of the end of 2022. Now, this may not seem like a lot compared to the dividends they are expecting to pay of $240 million, but when we look at the difference between the low end of earnings guidance, which is about $206 million, and compare it to the dividend amount of $240 million, that difference is about $35 million. So this means that Leggett & Platt could theoretically continue paying their current dividend for many years to come, even if their earnings didn't improve at all in 2023 or 2024. It would certainly not be an ideal situation at all for investors or the company as a whole, but they have the cash there to do it without taking on any debt. So that is certainly a slightly positive sign. And another potential light at the end of the tunnel is the fact that management also stated that they expect first quarter 2023 earnings to be down materially from the fourth quarter of 2022. And this at first doesn't seem like a good thing at all. But to me, it means that if earnings are down materially in the first quarter, in order to meet the earnings per share guidance that they laid out, that means that earnings will likely start rebounding and starting to improve in the latter half of 2023 in order to meet those earnings targets or guidance that management has put out. And if earnings start to rebound some in the second half of 2023, I think we could continue to see some improvement in 2024 as well, which would certainly be a good thing. And an improvement in earnings in 2024 is ultimately what the company needs to do in order to guarantee a bit more safety and security for their dividend and give themselves some room to grow the dividend as well. So I think there's certainly a risk that the dividend will be cut in 2023 or that the company will fail to increase the dividend in 2024. But overall, I am on the confident side that they will continue at the same dividend rate in 2023, and then we'll be able to fully cover a small dividend raise in 2024 from their net income alone. And like I mentioned at the beginning of the video, Leggett & Platt stock is down about 45% since their peak in May of 2021. So if we do think the dividend is most likely safe, we also might ask if now might be a good time to buy the stock. And I would say that for me, right now is probably a pretty good time to be buying, and I think around the $30 price range is pretty attractive for a variety of factors. But alas, I haven't personally bought any Leggett & Platt since December, and there's a few reasons for that. The main reason is that although I don't think Leggett & Platt is going to cut their dividend, they probably won't be raising it all that aggressively over the next few years, and they really don't have a strong track record of quick dividend growth either. Over the last 5 years, they've raised the dividend on average by about 4% per year, and in my portfolio personally, I'm shooting for an average dividend growth rate across the portfolio of about 8%. So although I do like Leggett & Platt and I certainly won't be selling it, it is currently over 5% of my dividend portfolio, and for me that's plenty large enough in allocation given the fact that it is a slightly riskier position, and I would say that I'm trying to focus more on higher dividend growth companies into the future. But that is all just based on my personal situation and goals and opinions, so it might make a lot of sense to be buying up lots of Leggett & Platt stock right now because their yield is over 5.5%, and if that's something you're looking for, then it could be a good fit. But like I said, this data along with my analysis is mostly just my personal thoughts and ideas about Leggett & Platt and why I think they probably will be able to maintain their dividend aristocrat status over the next few years. But if you do have any ideas or opinions to share, I would love to hear them in the comments section down below. And if you did enjoy the video, make sure to subscribe to the channel so you don't miss out on future dividend investing videos. Thanks for watching, and I'll see you all in the next one.